Jai Hind everyone. Welcome to my YouTube channel, which is Explore Yourselves, Banking and General Knowledge, etc. Today I will discuss some group discussion topics related to the internal promotion examination for banks. Welcome to part 1 of my Path Through the Corner Office 2025 to 2026 series, where we break down real bank promotion exam questions and help you and give you clear, practical sample answers about group discussions to help you climb the career ladder faster. Group discussion topic. First, digital banking versus traditional banking, which is more effective? Second, impact of RBI's recent monetary policy on the economy. Digital banking versus traditional banking, which is more effective? The debate between digital banking and traditional banking has gained massive importance in recent years, especially with rapid technological advancements, increased smartphone penetration, and changing customer expectations. Both models play significant roles in India's banking ecosystem, and each comes with its own strengths and weaknesses. For banking professionals appearing for promotion examinations, it is essential to analyze this topic from an operational, customer service, regulatory, and financial inclusion perspective. Digital banking. Positives, pros, and arguments in favor. Digital banking refers to the delivery of banking services through electronic platforms such as mobile apps, net banking, UPI, IMPS, digital wallets, and AI based solutions. It is designed to offer speed, convenience, and cost efficiency. Convenience and 24/7 accessibility. The biggest advantage is the ability to perform transactions anytime, anywhere. Customers no longer need to wait in queues for or follow bank timings. This improves customer satisfaction and reduces pressure on branches. Second, faster transactions and automation. Digital channels enable instant transfers, UPI, NEFT, IMPS, automated bill payments, eKYC, online account opening, and AI based chat support. These improvements increase operational efficiency. Third, low cost to the bank. Digital transactions cost far less than branch-based services. Over time, this helps banks reduce manpower, infrastructure, stationery, and cash handling expenses, contributing to higher profitability. Fourth, improved customer experience. Personalized dashboards, spending analytics, product recommendations, and assistance create a modern, seamless experience that appeals especially to younger and digitally active customers. Fifth, greater financial inclusion. Digital banking has significantly expanded banking across in remote areas. The JAM Trinity, Jan Dhan, Aadhaar Mobile, UPI, and the rise of fintechs have empowered millions who previously lacked formal banking services. Sixth, transparency and traceability. Digital trails reduce chances of corruption, leakage, and fraud in government benefit transfers. For banks, digital footprints help in better monitoring, KYC, and risk assessment. Digital banking negatives, cons, and arguments against. While digital banking has many advantages, it also introduces new challenges and risks. First, cybersecurity threats. Phishing, malware, SIM swaps, and frauds are increasing sharply. Senior citizens and less tech savvy customers are more vulnerable. Banks must continuously invest in security, which increases operational costs. Second, digital divide and lack of digital literacy. A large segment of India still struggles with poor internet connectivity, low smartphone access, and or limited digital skills. For them, digital banking is confusing and risky. Third, personal touch is missing. Face to face interaction remains important for many customers, especially for loans, complaint resolutions, or financial advisory services. Digital banking cannot replace human empathy. Fourth, technical failures and downtime. System crashes, server issues, failed UPI transactions, or app outages create frustration. Digital dependence makes the system vulnerable during power cuts or network issues. Fifth, exclusion of vulnerable groups. Elderly customers, people with disabilities, or those in rural areas often depend heavily on branch banking. Fully shifting to digital could alienate them. Traditional banking positives, pros, and arguments in favor. Traditional banking refers to the branch based model where services are provided through physical branches, in person interaction, and manual processes. First, trust, credibility, and personal relationship. Customers, especially in India, still value personal interactions with bank staff. Relationship banking helps in gaining customer loyalty and accurate financial advice. Second, safe and secure environment. Physical branches provide a sense of security. Many customers prefer visiting a branch for large value transactions, cash dealings, or documentation work. Third, essential for complex services. Loan processing, financial planning, wealth management, locker services, and dispute resolution are often better handled through human interaction rather than automated systems. Fourth, supports those who are digitally excluded. Branches remain essential for rural populations, elderly citizens, illiterate individuals, and those without access to smartphones or the internet. Fifth, strong regulatory oversight and established systems. Traditional banking follows well established protocols with physical documentation, making it easier to verify identity, prevent fraud, and maintain compliance. Traditional banking negatives, cons, and arguments against. First, limited accessibility. Branches work within fixed hours, often leading to queues and delays. Customers must physically travel, which is inconvenient and time consuming. Second, high operational costs. Branches require staff, rent, electricity, equipment, stationery, and cash management. This increases the bank's cost to income ratio. Third, slower processes. Manual verification and paperwork make traditional banking comparatively slower. Handling a large number of customers increases workload and reduces efficiency. Fourth, human errors. Mistakes in documentation, data entry, or cash handling can occur more frequently in manual operations. Fifth, lower scalability. Opening new branches involves heavy investment and regulatory approvals. Therefore, expansion in rural or remote areas is slow compared to digital channels. Digital banking versus traditional banking balanced comparison. A realistic assessment shows that neither model can fully replace the other. Instead, the future lies in integration. A. Speed versus personal touch. Digital banking offers speed, traditional banking offers reassurance and personal guidance. Customers can expect both convenience and trust. B. Cost efficiency versus inclusion. Digital platforms reduce cost for banks, but branches ensure inclusion for those without digital access. C. Automation versus human judgment. AI can process data faster, but complex decisions like loan appraisal, fraud assessment, and customer disputes still benefit from human judgment. D. Scalability versus reliability. Digital banking can scale rapidly, but traditional branches remain important for credibility and regulatory compliance. E. Younger versus older customer preferences. Youth prefer apps, seniors rely on branches. A balanced model satisfies both demographics. Final evaluation, which is more effective? Effectiveness depends on the context, customer segment, and type of service. A. For day to day transactions, digital banking is clearly more effective. B. For complex financial products, traditional banking remains superior. C. For financial inclusion, a hybrid model works best. D. For operational efficiency, digital systems outperform. For C. For custom E. For customers' trust, branches remain critical. Thus, both systems complement each other rather than compete. Conclusion: the debate between digital banking and traditional banking is not about choosing one over the other, but about understanding their respective roles. Digital banking brings speed, convenience, and cost efficiency, while traditional banking ensures trust, inclusion, and personalized service. In a diverse country like India, the most effective model is a which means physical plus digital approach where technology enhances efficiency but the human element remains intact. Banks that combine both models intelligently, digital for convenience and branches for relationship management, will ultimately deliver the best customer experience and succeed in the evolving banking landscape. Impact of RBI's recent monetary policy on the economy. The Reserve Bank of India (RBI) plays a central and decisive role in shaping the country's economic direction through his monetary policy. Every adjustment in the repo rate, reverse repo rate, cash reserve ratio, statutory liquidity ratio, or the overall liquidity stance has significant consequences for inflation, growth, credit availability, banking operations, investment climate, and general consumer behavior. The aim of RBI's monetary policy is to maintain price stability and support economic growth, but the actual impact of these policies varies across sectors and economic conditions. In this analysis, we will explore the positive and negative effects, but for the foreign against viewpoints and the overall balanced im- perspective on the impact of RBI's recent monetary policy decisions on the economy. Positive impacts, pros, arguments for RBI's monetary policy. A. Effective control of inflation. One of the strongest positive impacts is inflation control. When inflation rises beyond comfort levels, RBI typically increases the repo rate. This makes borrowing more expensive, reduces money circulation, and slows down unnecessary consumption. As a result, demand cools and prices begin to moderate. Controlling inflation is critical because unchecked inflation reduces purchasing power, affects household budgets, hurts savings, and destabilizes the economy. In this sense, monetary policy acts like a brake to protect the long term interests of the economy. B. Strengthens financial and economic stability. A tight monetary policy brings stability to the financial markets. Higher interest rates attract foreign investment, particularly in debt markets, which strengthens the rupee. A stable currency reduces import costs and helps manage the currency's external trade balance. Moreover, stable monetary policy enhances investor confidence, reducing volatility in financial markets. A balanced and predictable monetary stance influences long term capital formation and supports sustainable economic growth. C. Encourages savings and boosts bank deposits. When RBI increases rates, banks respond by offering higher deposit rates. This encourages households to save more, increases the flow of funds to the banking system, and improves liquidity in a more stable and controlled manner. Increased savings help banks fund productive lending and strengthen the financial base of the country. D. Promotes responsible borrowing and reduces risky loans. Higher borrowing costs discourage reckless or recessive or excessive borrowing both by individuals and corporations. This helps in improving loan quality and preventing the build-up of unsustainable debt. The banking sector, which has struggled the NPAs in the past, benefits from responsible lending behavior. When interest rates rise, banks become cautious while approving loans, ensuring better due diligence and risk assessment. E. Helps manage excess liquidity. During periods of high liquidity, inflation tends to rise. RBI uses monetary tools to absorb excess liquidity and restore balance. This disciplined liquidity management ensures that inflation remains under control while preventing asset bubbles such as rapid increases in real estate or stock market prices. 2. Negative impacts. Cons. Arguments against RBI's monetary policy. A. High borrowing costs slow down credit growth. A major drawback of increasing interest rates is that borrowing becomes expensive. Housing loans, vehicle loans, personal loans, and MSME working capital loans all become costlier. This discourages new loans, slows consumption led demand, and reduces growth in credit sensitive sectors. Individuals postpone big ticket purchases, directly impacting industries such as automobiles, real estate, and consumer durables. B. Slower economic growth and investment activity. Higher interest rates reduce corporate borrowing, discourage expansion plans, and delay long term investment decisions. When companies hold back investments, production slows, profits decline, and job creation weakens. Over time, this can contribute to a slowdown in overall GDP growth. A tight monetary policy that may help manage inflation, but the trade off is slower economic recovery and reduced business activity. C. Adverse impact on MSMEs and small businesses. MSMEs are highly sensitive to interest rate changes because their margins are already thin. When RBI increases rates, banks adjusting lending rates upward, making working capital loans expensive. Small businesses suffer due to higher input costs and reduced profitability. This may even lead to closures, delayed payments, and job losses in the MSME sector, which is one of the largest employers in India. D. Reduce job creation and employment opportunities. When companies scale back on expansion and investment due to high borrowing costs, employment opportunities naturally decline. Job creation in construction, manufacturing, retail, and service sectors become slow. Youth unemployment and rural distress may increase if monetary policy remains tight for an extended period. E. Negative impact on stock markets and investor sentiment. Higher interest rates reduce liquidity in financial markets. Investors tend to shift money from equities to fixed income products such as fixed deposits and government securities, leading to stock market corrections. Volatility increases and investor sentiment weakens. This can discourage retail investors and impact wealth creation. 3. Balance comparison. A neutral view. RBI's monetary policy decisions must balance inflation on one side and economic growth on the other. When inflation rises sharply, prioritizing growth alone is risky because it may weaken the currency, increase import prices, and lead to long term instability. In such situations, tighter monetary policy is justified. Conversely, when growth slows, unemployment rises, or industries struggle, a tight monetary stance can worsen economic conditions. Reducing interest rates and easing liquidity becomes necessary to revive demand. Thus, monetary policy is like a seesaw. It must balance price stability with growth. The correct stance depends on current economic conditions, global markets, crude oil prices, fiscal deficit levels, and geopolitical risks. A single policy does not suit all situations, and the RBI often adjusts its stance gradually to minimize economic shocks. In simple terms, if inflation is high, tight policy helps more than it hurts. If growth is weak, loose policy becomes essential. If both inflation and growth are unstable, RBI must choose a middle path. This balanced approach ensures the economy remains stable and resilient. Conclusion in conclusion, the impact of RBI's recent monetary policy on the economy is multidimensional. On the positive side, it helps control inflation, stabilizes financial markets, strengthens the rupee, encourages savings, and promotes responsible lending. On the negative side, it slows down borrowing, affects industries and MSMEs, reduces job creation, and puts pressure on the economic growth. The effectiveness of monetary policy depends on timing, intensity, and economic context. While there is no perfect policy stance, the RBI remains to maintain a balance between price stability and economic development. A calibrated and flexible approach, neither too tight nor too loose, ensures that inflation is managed without compromising growth. Ultimately, the goal of monetary policy is to build a stable, strong, and sustainable economic environment for the entire nation. Thank you very much for your patience. Please like and share this video and subscribe to my YouTube channel.